Hello, and thank you so much for joining us for another Pegasus Edge 20. I'm your host, Justin Moya, and I wanted to really thank you all for joining us for another one of these weekly meetings. As JD said in Is It a Career or Is It a Job? The number one thing that distinguishes many financial professionals is the knowledge that they have when they're sitting with a client. Are we able to help them, or are we missing something? So we want to make sure you don't miss anything, and today is another great topic that we have prepared for you. And this really focuses on that underlying risk that can completely throw off retirement. And it's a discussion that you should have with every pre-retiree or current retiree in your book of business or that you prospect on a daily basis. Now, just a reminder, Pegasus Edge 20 is every week. We try and keep these to 20 minutes or less. I do my best to try and keep that timeline. I usually go over because I'm a talker, but I try and keep it as close to that. It is twice a week in both English and in Spanish. It's Tuesdays are English, Spanish is on our Wednesdays, both at 11 a.m. Central. And if you ever miss anything, you can actually go to our YouTube channel. If you just go to youtube.com, search for Pegasus Insurance, you're going to see our logo. Go ahead and click on that, and you can actually find us there. Otherwise, you can just go to youtube.com/@Pegasus Insurance. It'll take you direct to our channel. So if you miss anything, just make sure you go over there. So let's talk about the care gap right now that we have when it comes to long-term care. And yes, that is the hidden retirement killer, right? We talked about this a little bit ago, 2 sessions ago, I think, or 2 or 3, where we were showing you how to use a hybrid life policy that you can use to help solve this problem. But sometimes we run into an issue where the client may not be able to qualify for the insurance, or maybe the insurance isn't the big priority, right? So let's talk about how we can get them moving forward using this product that we're going to speak about today. And again, the first thing is 70% of people turning 65 today are going to require some type of long-term care service. So that's in-home care, assisted living, maybe even just some kind of hours, right? Adult daycare or something like that. But they're going to need some form of help. Oftentimes we see many family members coming in because the cost is just so high, which we're going to talk about. Now, it's very interesting. So I did a kind of a quick Google search, and I found that there's roughly only about 15 carriers right now offering a standalone long-term care policy in the market. And this is a complete change, as you're going to see. So we have a big need from everybody, but we have a small number of carriers that are saying, hey, we're going to come in and help. And many of those plans may not be as competitive, but they're staying in there so they can continue to, put increase in rates, or, offer the benefits, make sure that the clients are taken care of that they have already sold. Now, this is not an annuity rider, right? This is actually built into the plan that we're talking about today. So let's go ahead and talk about that. As we continue on, we know that 88% of adults, 50 to 80, are going to want to age in place. And if you think about it, just think about yourself. Okay, if anything happens, you get sick, you need some help, is the first thing you're going to want to do is leave your home? Maybe you've been in for 20, 30 years. No, the answer is that that's our comfort. That's our safe place. That's where we've kind of built, right? Humans are creatures of habit. I want to sleep in my own bed. I want to sit on my own couch. I want to watch my own TV. I want to be in the place that I raised my family. And 56% of those turning 65 will have, again, some need for long-term care services at some point in their life. And 22% will need that care for at least more than 5 years. Now, you already have these kind of conversation starters, or these clients that are looking to have this conversation. It's just you're not having a part in that discussion yet. And that's because we just don't go out there and discuss it. Before, you really had to be in the long-term care market, right? You really had to be with all of the different carriers and understand the benefits and understand the partner programs and go through a complete calculation. And there still are agents that really just focus on the long-term care. But again, the best agents, the ones that are, making a career out of this, these are the agents that are multi-selling. So they're selling, a little bit of each portion, right? Continuing that conversation and helping take care of all of their clients' needs. Not, well, I'm your life guy, Go over to this person and they're going to do your Medicare. Go over to this person and they're going to do your long-term care. And go over to this person, they're going to do your annuity. You should be able to handle the majority of needs when it comes to our insurance products. And at Pegasus, we have all of the products, the expertise, and the ability to help you cover every single one of those markets. Now, when thinking about long-term care, I'm going to tell you, we've talked about this before, we see women more often than not interested, right? And it's because they're carrying the bigger exposure and they know it, right? Most men think, well, I'm going to die before my wife. So what does that mean for the wife? Is she going to have a plan in place? Who's going to take care of her? Oftentimes, it's the children that end up having to step in, or it's the sister, or it's a niece, or it's a grandchild that's having to step in. And if you've ever listened to us when we discuss on the women's market, we find out that women who take time off to care for an ailing parent or family member actually lose time and lose the ability to earn money to put towards their retirement. So there really is a big gap because of that. And we know that 51%, so 1 out of 2 women are going to need some type of long-term care at 65, and about 39% of men are going to need long-term care over 65. And again, women have kind of a longer exposure. So the average stay for a woman in a long-term care facility or that needs that help is 3.2 years, where men is roughly about 2.3 years. Men, this is why we pay more when it comes to life insurance, and women, this is why you pay less. But it's the quite opposite when we look at a traditional long-term care. Women typically pay more than their spouse, and it's because of this stat right here. Now, when you think about if I need care, the number one question is, how am I going to pay for it? Okay, 3 years in a private nursing home is running about $389,000. Now, that's a nursing home. That's the most expensive. Now, do you have $389,000 in your assets that you can peel off and just put towards a nursing home? And if the answer is, well, yes, I have that money. If you were to spend that $389,000, would that significantly impact what your wife would have to continue on her retirement? Do you have another $389,000 in the bank for her? Is that going to impact the gift that you want to leave your heirs? The answer to that is typically yes. Okay. Right now, the average stay in an assisted living facility is about $6,200 a month. And we can attest to that, right? We have dealt with some family members, my own grandparents, and I can tell you that as they needed that assisted living facility, that was roughly about the amount that we were paying. Now, if you want to go into a private nursing home, that's at $10,798 a month. Ooh, can you imagine coming up with that every single month? Wow. So this conversation really is a great starter to have because it's something that people are worried about. Yeah, I'm worried about that $6,200, or I'm worried about that $11,000, but I'm just going to have to deal with it when it gets here. Or my kids are going to have to figure it out. Now, if you talk to any mom, there's no mother on this planet that says, well, my kids are going to have to figure it out and I don't know. Most mothers don't want to be a burden on their children. They don't want the children to have to worry about that. So the question is, what can I do today to help you offset that burden or that problem where you're not a burden to your children anymore? And that brings us to the product that we're going to talk about today. This is the Equitrust Bridge Annuity product. Okay, I love this product. I think it's a great product that we have in our portfolio, in our arsenal, and one that we should be bringing out. But what it does is it provides guarantees to your client for the long-term care expenses that they're going to deal with tomorrow. So how does it work? Well, it's not just one annuity contract. Basically, think of it as 3 different plans built in. First off, we have a fixed annuity asset, right? Fixed index annuity where we're going to take some money, we're going to take some unused funds, and these have to be non-qualified funds. Now, if you have a non-qualified annuity, great. Cash in the bank, great. CD, great. Sell from a recent home, excellent. These are the plan type of funds that we're looking for. We can't use a 401k or an IRA or any type of funds like that. Unfortunately, it's not set up, and I'll tell you why here a little bit later. The other thing that we have is a long-term care rider, right? This is going to be built in, that's going to pay for those long-term care expenses. And it's built right into the contract. There's nothing extra that you have to do for that. And then finally, we have that death benefit. Again, I don't want my money just sitting there losing value. It's not going to happen. We have that indexed annuity where they're not going to lose any value on the funds, right? If the market drops, we're not going to have any sudden shifts or sudden losses of value. We're still going to be able to grow it if the index continues to increase. We have the guarantees that the long-term care rider have, and we have the death benefit. If you never use your long-term care benefits, your children are going to receive the assets. We're still going to be able to pass that over, plus any growth that the product has had. Or let's say you only go on long-term care for a year. I only use a year of benefits. Well, the rest of that, the growth and everything else, is going to again pass to the children. So it's a wonderful type of plan. The other portion is it's because it's a long-term care, and if the benefits are paid out in that long-term care rider because they need it, it's all going to come to the client tax-free. So now we're taking an annuity, right? Non-qualified funds, or we're taking some money out of the bank and we're putting it in. We're letting it grow 5, 10, 15 years. And when the client needs it, they're going to receive a monthly check, income tax free. That's huge, right? And we still have that death benefit. Now, it works because we're multiplying the benefit, and that's really what this does, right? We are taking the premium and then we're going to multiply it by a coverage ratio. That coverage ratio is really going to be determined by your client's age and underwriting class. So you have, the younger you are, the higher the ratio you're going to get. I think it's up to almost 312% or 350% that they can get. And that's if they get it very young, right, in their 50s. But as we age, we're going to see that coverage ratio kind of decrease. If they are in good health, right, they get the preferred, they have a standard or a select, and then they have a guarantee issue. The better health they are, the bigger that multiplier benefit's going to get. Now, I said we have a preferred. Underwriting is going to be involved in that. That's the number one thing. But the best part is your client can choose, do I want to go through underwriting? But sometimes maybe I can't qualify, or maybe they're not doing so well right now. We know it's going to be a problem. It's not going to be for a few years. So we want to start planning on this today, but they're not going to be able to pass that underwriting. And I'm not talking about labs, exams, any of that. It's all going to be video underwriting. So it's done on the spot. You can actually get an approval before you walk out of the house. So we can go with that secure, which is their guarantee issue, and it's going to be a smaller amount. Maybe it's going to be about 150 times or 150% of their value. But again, we're stretching their dollars more, and we know that they're going to need that care sooner than later. But with that, that's going to give us our full LTC benefit. And I'm going to show you an example of how this works here coming soon. Now, I talked about that growth potential, right? There's different ways that you can grow the cash value. So it's not just sitting there earning nothing or deteriorating. We're sitting down and we're actually putting these funds to work. Now, today, if you were to start a policy, take a look at that 1-year fixed interest rate. It's 5%. Most of the time when we're having these conversations, the clients have those money or those funds in a CD. At 5%, we're beating many of the CD offers that are out there. It's an absolutely wonderful plan, especially for the first year. Our 1-year point-to-point cap is 9%. I think that is a tremendous cap rate that we have. We have a 50% participation in the S&P, a 95% monthly average. We have that Barclays Focus 50 at 180% par rate, and then kind of the darling, the S&P Mark V at a 200% par rate. So wonderful options that you can turn around, offer your client, make sure that their money is continuing to work for them. And best part yet, since it is in a fixed indexed, let's say we start getting through retirement and the client says, oh no, I'm starting to run out of money faster than I thought, right? Inflation is going up higher, something happens. They still have access to the cash value. So if they determine, hey, I need the cash, the long-term care benefit isn't as important right now, they can actually start withdrawing from this or roll it over or walk away from the plan just as they would any other indexed annuity. But this one is built more for that long-term care purpose as well. So again, they have flexibility inside of it. Also, this is a flexible premium plan. So if we start off with a small amount today, and the client wants to add more money, let's say they're going to have another CD that's maturing in a couple of months. They're going to be selling a home, they have rental properties, something like that, and they want to add more into this plan, they definitely can in like the second or even third year. So we do have the ability to add more into this for them. Now, every contract is going to come with a coach. What do I mean by that? It's going to come with this never stop benefit. Now, it is a paid benefit, it's $100 a year. Okay. I recommend all of my clients keep this benefit. It's going to be included with every contract from the beginning. And what happens is after the policy is done, the Never Stop team is going to reach out to your client. Typically, they're going to reach out by one phone call and they're going to email your client. Make sure your client takes this call and follows through with the coaching plan. I'm going to show you why. It actually means cash in their pocket for long-term care. They're going to receive a dedicated coach, some accountability, they can download an app. But the big reason why is every 2 years, as long as they follow the plan, they're going to receive extra benefits that's going to fund their long-term care even higher. Okay? Now, you might be thinking, I don't like long-term care, right? And we think of the traditional long-term care. Why don't we really like long-term care? Number one, it's a whole different ballgame when it comes to underwriting. So we're doing full medical exams, we're getting medical records, and it's different than the life insurance underwriting. Remember, life insurance is underwritten on mortality. Long-term care is underwritten on morbidity. Two different types of plans, so we now have to learn a whole different underwriting guide. It could take weeks or even months in underwriting. There is a real chance that we're going to put in a lot of effort, be submitting these applications, and we're going to get that decline. So we're not going to, have anything to show for it at the end. Again, it is priced high. So we're sitting down and we might show a low cost in the very beginning. Women are obviously going to be paying a little bit more. But every 2 years, these companies will be, have the option to raise rates. And in our experience, they have. We had a client that we ended up moving over. They had a policy with another long-term care carrier that they've had for years. Their policy was $900 a month. When they first started, I think they were in the, maybe 100, 120 a month. $900 a month today. And they received a letter in the mail saying your policy is going up 50%. I think it was going up 30% one year, 20% the next, but 50%. Now, they just turned to us and said, I can no longer afford to keep this policy in force. I've been paying on it for decades, and I can no longer afford to keep this policy. So the company gave them an option. Hey, well, if you can't afford this premium, you can reduce your benefits and keep your premium the same, or you can reduce them even further and maybe reduce that rate. That is hard to come by. The plan that you've been keeping for years, decades even, is no longer affordable, and everything that you put into it now, all of a sudden, now we have to start dialing it back, especially at the older ages when we may need it the most. This plan, again, digital underwriting, no medical exams. We have that guaranteed approval, so we don't have to really worry, is my client going to be approved or not? I can go to somebody that's in a wheelchair, you know what I mean? Or I shouldn't say a wheelchair, but I can go to somebody that, is on the decline, and I know that I'm going to have more money for them than they put into this. It closes the timeline to the annuity sale. It's priced unisex, so the offer that I offer the husband is going to be the exact same offer that I offer the wife. You're not going to have anybody say, well, why does she have more money than I do? Again, the only thing that's going to change is if that wife is a little bit younger, right? We're having that bigger multiplier factor. And we have the ability to increase the benefits. It's not through a COLA or an inflation rider or anything like that. It's actually built in through that Never Stop. Now, let's talk about a sample client. This is a client that we're working with currently. It's a 74-year-old female. She's widowed. She just sold some assets and she turned around and we were having a conversation. And again, one of her biggest fears is, well, I saw my husband on the decline. I was there for him, but I don't want to be a burden on my daughter. Okay. What can I do? And we started having this conversation. And by the way, the conversation started, we were talking MIGA rates. Again, this money was earmarked for a CD. We started into the conversation. What is the current rate? How can I lock into it? Those are the things. But as we started talking with her, this was one of the main concerns. I don't want to be a burden to my daughter. So I said, well, we might have an option instead of using this money to stick in and grow, because the ultimate goal for her was just to leave this to her daughter when she passes away. I don't need the money. I'm not going to need to tap into it. At least I don't expect to. I just want to leave this to my daughter. So I want it to grow as much as possible. But at the same time, if she did need help, her number one resource was, well, my daughter will take care of me, or my granddaughter will take care of me. Now, what's going to happen? If she needs that assistance, one of those two individuals are going to have to take off of work. Trying to care for an adult is a full-time job in many cases, or you have to pay somebody while you're at work. So where are we going to come up with the funds? Well, we built out this plan. So here in front of you is a copy of the illustration. I removed her name. But take a look. At age 75, we have $50,000 that we put in. Now, the one thing I really want to highlight, all of the values that you see in front of you in this illustration is going to be guaranteed. I'm going to show you the non-guaranteed values and how that works as well. But guaranteed, she's going to put in $50,000. There is a vesting period, which we'll talk about. But let's say at age 85 or even 84, which is the typical age that most women will need some kind of assisted living, she now needs some help. Take a look at what we have here. My accumulation value at age 85 shows $37,456. Now I know what you're thinking. Justin, I thought you said this has the opportunity for growth. Well, remember, when we're talking guaranteed values and when it comes to annuities, this is showing absolutely zero growth year after year after year. And there is a fee, right? This is an LTC built in, a true LTC, but it is a rider and they charge you a fee for that. So we are going to see that accumulation value decline over time. The other thing that we're going to show is we do have that death benefit. So what happens in 5 years if I pass away? Well, you're still leaving your daughter about $47,710. Again, that is showing zero growth over the last 4 years or 5 years. But take a look at this, even when we run to zero. So look at year 18, right? There's really no funds left in it. The client's 92, account is at zero. What is my long-term care benefit? I still have $4,341 monthly that would be paid in the event I need long-term care. At age 85, typical woman needs, I have $3,530 for long-term care cost. And that's going to be paid to the client tax-free monthly for the next 5 years. That is 60 payments of $3,530 coming in. Now, let's take a look at our non-guaranteed, right? This is showing some performance. Again, we have that same $50,000 coming in. Look what happens to my accumulation value. Now, this is assuming no withdrawals during this period of time. I'm showing you kind of the best case scenario. But at age 85, if I were to pass away or she were to pass away then, or even let's say 90, we are adding value into this plan. So our death benefit is still there. Oh, looks like my death benefit button. There we go. Our death benefit is there and it's still growing. So again, we're having an asset that's passing on to the children. Now, the death benefit. If I go on claim and I'm pulling out $35.30 a month, that's going to reduce my death benefit dollar for dollar. But if I don't use up that entire amount and I pass before that, my family is going to receive the excess funds. Now take a look at my long-term care monthly benefit right here. This is just going to continue to move up. So we have our guaranteed. So if we look at age 85, which is right here, let's go ahead and slide this over. We are guaranteed $3,530 a month. But as you see, we have the opportunity to have up to $3,782 a month. So again, we're building in a little extra cush there as time goes on. Now, when they go on claim, that $3,782 or that $3,530, that payment is going to remain the same for all 5 years. Okay. but build that in with other plans, Social Security, maybe they have a small pension or retirement or other monies coming in, that's going to just go on top of that. And we're not trying to cover the entire cost of the long-term care. If we did, we would need to put in more money. We're just trying to lessen the blow and give the client some options, especially for some funds that she earmarked, to pass on to her daughter anyway. Now, how do we get more credits? Again, it goes down into that wellness credit. Now, I really want to point out one thing. You're going to see where it says vested balance. If you look in the first years, we see very low long-term care amounts. That is because the benefit is actually vested over 4 years. So pretty much every year we're going to get 20%. 20% of the vested balance up front, 20%, 20%, 20%. Finally, we have 100% in the year 5, right? When we're in the 5th year, we have 100% vested and we have that full benefit. If you look over 5 years, I turned 50,000 into 177,396 guaranteed. It's going to give me a guaranteed value if she needs the care in 5 years of $2,956. Now, if we look at our wellness credit right here, take a look at this. Absolutely amazing. This wellness credit is sitting here. We have $2,678 that is credited in the 2nd year. That's following that coaching plan that Never Stop gives us. And every 2 years, we're going to see an extra amount added to the plan. If we look at our cumulative wellness credits right here, you're going to see in 10 years, we have added an extra $15,000 of benefit to her long-term care plan. And that is going to give us our total amount. So we've turned $50,000 if she follows that Never Stop plan in the 11th year to over $226,000 of potential long-term care benefit. On the vested side over here, guaranteed in the 11th year, we've turned $50,000 into over $211,788 into guaranteed long-term care benefits. Your client cannot lose. If you're planning for long-term care, we have those guarantees, but we also have the ability to give your client a little extra bump, as we see here, right, on what our wellness credits would be. So again, what did we do? $50,000 in. At age 85, guaranteed $211,788. That's $3,530 of tax-free money for the next 5 years, 60 months. That is amazing. Especially think about those clients that have maybe been in an annuity, right? Non-qualified for a while. They put in some money. Maybe it's grown. We've had it in a couple of MIGAs. Now we're planning for long-term care. They've never paid taxes on that growth. We stick it in this plan. It's continuing to grow, right? Leave that death benefit for the heir. But all of a sudden now they need long-term care, and we're turning all of those funds that we have had tax deferred into tax-free income. It is absolutely an amazing value and a way to extract this as much as possible and help that client remain in her home or receive the best care possible, right? We just gave her 4.2 times the amount that she's put in at age 85, guaranteed. Now, why do most people skip LTC? We've talked about them, right? I don't want to be the LTC guy. It's too complicated. You aren't. You're the annuity guy. We're layering in that long-term care. Underwriting is going to kill the deal. I don't understand it. Don't want to deal with it. We have guarantee approval options. That's a conversation you have with the client, and we can actually illustrate that, right? We don't have to worry about the decline. It's a one and done sell. No, this is an annuity. The Never Stop benefit plus the annuity, it's giving you that annual review, and it's giving you multiple opportunities to step in front of the client and add multiple products, Medicare, annuities, referrals. Right now we're having that conversation and we're talking to the family members. It's a great plan to sit with. Now, here was something that kind of floored me. In the early 2000s, there was over roughly 100 carriers selling some version of a long-term care product. In 2010s, that dropped to 30. And today, there's roughly about 15. That's huge. Long-term care has become such a need and so expensive that it's driven 85 different carriers out of the market. So what I'm telling you, jump on this train while we have it today, a single premium, guaranteed benefits, And in the future, if Equitrust decides to get out of the market, your client has that golden contract that everybody wished that they had bought, 20 years ago. Now, you don't need to really build the story. We have many of this things and tools for you on the Equitrust website. We have a calculator that you can run. You don't even need a login for it. We have an illustration tool. We have underwriting guides that will show you on a video underwriting. We have coverage ratio sheets. We have agent guides. We have flyers. We have booklets. All of that is going to be right there on the microsite, which is agents.equitrust.com/bridge. If you have your phone, go ahead and pull your phone out, scan that QR code, and it's going to take you there. I'm going to leave it for about, let's say 20 more seconds, and then we'll go ahead and move forward. Okay, so what are the 3 things that we should be doing before the end of this week? Number 1, pull every client that is 60 or over. Pull that. By the way, you should be pulling this anyway, right? 60 or over, they're getting closer to retirement. They're having those conversations. Their policies may be coming to an end. We need to have that conversation and we need to start priming them, right? Get them ready for what's coming ahead in that next chapter of their life. Pull 5. You can pull your entire list. Pick your top 5. Pick the top 5 that you've had a good relationship with. Have that long-term conversation. Hey, I was just thinking about you. Let me tell you what we've had to go through. Share a personal story. You can share our story, a friend, a family member, something that you've had. And what I want to do is I want to make sure nobody goes through that same, heartache that we did. So I want to bring this to your attention, and then set the appointment. Let me just show you. Let's set up. It's going to take no more than 30 minutes. Let me show you how this works. Set at least one client appointment this week. It can be next week, it can be over the weekend, it can be after work. Set that, go out and show the plan. The worst that the client can tell you is, you know what, this is something that we thought about, but this really isn't the way that we want to go, or maybe I don't have an extra 50,000 sitting around right now. Well, that's a great time to pivot over to the chronic illness rider that we had. And even if that is an issue, we even have short-term care products that can help, but start that conversation with your client. Listen, 85 carriers have walked away from this problem, and you didn't. You didn't have to. Be that person that is planning for the future and making sure that we're not derailing your clients' retirement dreams. Again, I'm your host, Justin Moya. If you have any questions or if you want to see illustrations, 505-298-2111. There's my email right there. Now, if you're on our presentation today, up in the top left corner, you're going to see the little chat bubble. You can click on that, send us a message. I'm going to go ahead and answer any kind of questions that you have. But thank you very much, everybody, for being on this call. We really appreciate your time. Again, I didn't meet my 20-minute mark. I came as close to it as possible, but we really appreciate your time there. I hope it was well spent, and I look forward to discussing your next client with you. Goodbye.